how many stocks should you hold in your portfolio? Conventional wisdom says it might be 20 or 25 even. But that sounds like it could be a lot of work to manage. And if you're already getting your motivation to start sapped at the thought of it, fear not. We're about to hear why just 10 stocks could be enough to offer the upside potential you want and the diversification you need. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. I'm excited to be back from our summer hiatus here, and I'm really looking forward to digging into the nuts and bolts of this unconventional 10-stock strategy. The idea really resonates with me as someone who loves to invest, but doesn't want to spend all my time glued to my screen tinkering with my portfolio all day. So let's bring in the mind behind this small but mighty portfolio strategy. Joining us is Ange Matthews, founder of the Happy Investor Method. Ange, wonderful to have you with us. Really appreciate you taking the time.
Thanks so much for having me here.
One of the things I really love about your content, Ange, is that you make investing, which can often be perceived as very serious, very dry, you make it very positive. You bring a fun factor to it with your Happy Investor Method. So tell us, what is the Happy Investor Method all about, and what brought you to this point?
Well, I actually started my career making just $40,000 a year while carrying 6 figures of debt. And honestly, investing is the only way I was able to pay that off and create a life that I have today. And that's why I created the Happy Investor Method, to make wealth accessible and fun. And my mission is really simple. It's to help people frame financial goals into one that actually motivates them and gets real results.
So what's the happy in Happy Investor Method?
I think it's important to start with the emotion that we want to have with anything we do. And typically speaking, investing could seem really scary. It can be really intimidating. But when you approach it from, say, happiness and joy, I think that sets the tone for the conversation you want to have for it. And that's why we call it the Happy Investor Method.
And what sparks joy, to use a Marie Kondo phrase here, with investing? A lot of people might think it's just money, it's just numbers, it's just math. What brings you joy in your portfolio?
Well, when I have a really hard day and I come home and I look at my portfolio and I see that the markets were moving, my investments were growing, and someone was working just as hard as I was day in and day out, it makes me feel genuinely happy because I don't feel as if I'm the only one responsible for bringing wealth into my household. I have a partner, and it's called the markets, and it's called my investments. And that makes me really happy to know. It brings a lot of joy to my heart.
So I'm curious then, with the Happy Investor Method that you've pioneered here, how has it helped you work towards some of your financial goals?
Well, initially, it helped with just paying off debt. That was something that was really important to me, learning how to invest, utilizing a greater interest rate versus the one that I was being charged for my debt. Once that happened, it was really beautiful to have my investments get our first home. It helped me take a maternity leave that was way longer than the norm. And it even helped us to get even bigger investments like hotels and other things like that. And so for me, investing has really helped me become the woman that I am today, the adult that can take care of her parents, the adult that can take care of her children, and really help my community.
I love the idea of money and investing bringing joy, not just being something that you have to do, but something that enables you to do the things that you want to do. And of course, one of the really interesting aspects of your Happy Investor Method that we're going to talk about here today is that 10 stocks is all that it can take, you feel, to build the core of a portfolio. So let's talk about it. And for those in our audience, if you want to get in on that conversation, make sure you submit your questions to us. We're going to take as many of them as we can at the end of the show and have Ange answer all the things that you want to know more about. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box there for you. And if you're watching on our YouTube live stream, just click on the link in the description. It's going to take you over to our broadcast platform, and that's where you can answer or ask your questions rather. Okay, Ange, so I first want to just kind of understand the rationale behind this small but mighty stock portfolio idea that you have here. Why just 10 stocks?
Well, I think managing 25 or 50 stocks can feel so overwhelming, and most people give up before they even start or see traction. So I believe 10 stocks could be enough to really have an anchor in your portfolio. It's affordable, it's manageable, and it still offers strong diversification if done right. Even if you buy 10 shares of 10 companies, you're still going to have 100 shares as a starting point, which I think is a great way to build.
I'm curious how you came down to the number 10. Like, why not 15? Why not 12? Why not 8? Like, where did 10 come from?
I love easy math. And so it's really interesting. Growing up, math wasn't the strongest suit for me. However, money really got the juices flowing. But when you think about 5 or 10, multiples of 10 is just really easy. It's just easy math. 10, 20, 30, 40, 50, all the way up to 100. And then you can do 100, 1,000. So I love the idea of 10. And I also really love it because it helps me to utilize the 80-20 principle. And what that means is simply that 20% of your holdings are going to drive 80% of the results. So I know that out of 10 stocks, perhaps 8 might not work out phenomenally well, but 2 of them are going to do above and beyond exceptionally. And so it's just easy math, and I think it's really an approachable number for success.
You had me at easy math, Ange, okay? I also stopped taking math classes in like grade 10 or something like that. So yeah, anything that's a nice round number, that appeals to me too. Now, I'm curious, what are some of the guiding principles that you feel investors should be considering when they're choosing the 10 stocks in their portfolio?
First things first, I believe that your stocks and your portfolio should align with your personal values. This is really important because money is an extension of you. And that footprint, you really want it to align with who you are as a person. So an example is before I even start thinking about investments or how many investments I'm going to have in a particular company, what I think about is this aligned to who I am? An example of this is I don't invest in weapons or tobacco companies because I don't personally appreciate the social impact that they carry. So once I figure that out, it kind of makes it easier to think about, okay, I am in partnership with a company that I'm going to invest in. And now I have to see if this is going to be a good partnership or a bad partnership. And so I love it because it has way more control than an example, an ETF, but it also allows you to diversify a little bit too.
Yeah, I think I've heard that before too, whether it's like an ethical investing or just something where whatever your values tend to be, it gets you more invested, pun fully intended, I should say, in sticking up with your portfolio, staying on top of the research and stuff like that. Is that something that you found personally?
Absolutely. It keeps me motivated to keep going. An example would be I wanted to have a new home, and I didn't have a new home just yet. We were saving up for the down payment, but I went in and I invested in home builders. And it made me so much more excited about the opportunity of one day having our own home. But I knew in one aspect of it, my money was already out there building homes and creating safety for other families. So I knew it was just a matter of time before it happened to me.
Awesome. Now, I do want to play devil's advocate here a little bit here. One of the things that I've heard sort of as a counter to, let's call it values-based investing or ethical investing, is that money doesn't care about your feelings, right? Like in other words, ethical businesses or the businesses that you care about don't necessarily generate better returns, and that investing should basically just be about making as much money as possible. What would you say to that?
I will say that an investment is supposed to be an investment. It's not a donation. So I understand the notion of that. However, you get to decide the way you want to have your money grow. And if that is your opinion, that still is a value of yours that someone might have if that's their own thought and belief system. It really depends on you. And so what I find is regardless of what you want it to actually motivate you. So if having stronger returns is the motivation, great. If investing in something that aligns with your beliefs and your values is going to help you motivate you, then even better. Whatever gets you to the table to actually do this consistently is what's going to work best for you.
Okay, not to be a drag, but I'm going to play devil's advocate again. Okay, the other aspect to this too is that one of the things we constantly hear in investing is that diversification. It's the only free lunch in investing, right? You want to be diversified. Temper some of that volatility in your portfolio. Don't put all your eggs in one basket, right? I think a lot of people can understand that. So, what would you say to a skeptic who says, "Listen, 10 stocks. Like, there's no way you can get enough diversification with just 10 stocks"?
I think you can. I think if you're to think about an example, your closet, right? And you think about the clothes that you wear. A lot of us typically only wear the same 10 to 15 items every single day, and you're pretty well clothed. There's enough diversity within your closet for you to understand that perhaps this could work for your investments as well. And I think if someone's truly concerned about diversification, they could hold a few ETFs or mutual funds, and that could give them really great exposure to indexes like the S&P 500, for example. So I don't think that having 10 is necessarily going counter to diversification. I think you can still fully embrace it.
Okay, so just a point of clarification then, when you say 10 stocks, really what you're talking about is 10 securities, right? It could be an ETF, it could be a mutual fund, it could be a stock, what have you. Really just 10 investing assets, if you will, within the portfolio. That's what you're kind of getting at.
Yes, that is exactly what I'm saying. When I say stocks, what I really mean is securities and it's a financial term, simply meaning investable assets. Here at the Happy Investor Method, we tend to teach folks who are just beginning their journey with investing, or they've tried and they haven't really gotten the traction. And I don't want folks to get too caught up on jargon. But yes, you are absolutely correct. The technical term is securities.
Okay, good. So for beginners who might not have been familiar with that term, there you go. But that's what we're talking about here. So thank you for clarifying that. I'm going to play skeptic one more time, Ange, I promise. And this is the idea that picking stocks, can be difficult in the sense that, you're not guaranteed to beat the market, so to speak, right? Like nobody knows what's going to happen in the future. Some people would say keeping it simple with a really diversified index fund or something like that makes more sense. It gives you a better chance to get decent returns rather than the sort of like potentially boom bust approach that stock picking can give. So why do you like to pick stocks, at least to some extent, within this 10 security portfolio that you have?
Well, I think proximity matters. And when you have a high conviction or a high calling to pick a specific company and work with them to build your wealth, I think it really gives you more skin in the game. And I think it's also very important for people to invest where their experiences in life align. And so an example of this would be, for me personally, I love tech. Honestly, I wouldn't be the investor that I am today without platforms that allow me to invest via my phone or online. If I had to go physically to somewhere, it would be a lot harder, but tech makes that possible. I love AI. I love things that are pushing humanity forward. And so as a result, I invest in a lot of tech companies. I might have financial companies because at the Happy Investor Method, we teach financial education and awareness. And so for me, I think picking those individual companies that make me who I am as Ange Matthews, I'm going to be able to see a better performance because not only am I going to see when it's doing well, but because I actually use the companies and I'm so ingrained in that ecosystem, I get to also see why it might not be working. And so I believe that, yeah, it's actually okay to pick individual stocks because I'm not trying to beat the market. What I'm trying to do is have a deeper relationship.
Okay, so you kind of teased it there, your tech exposure there. Let's take a peek inside your 10 stock portfolio here and just learn a little bit more about your personal approach to putting together a portfolio. So we created a graphic here that kind of breaks down your stock asset allocation here within your portfolio. So can you just kind of walk us through how your portfolio is constructed?
Yeah. And so it's really interesting because when you see my portfolio, you might see that I have a lot of tech stocks present. You might also see that I have a bit of discretionary, and it's really spread out, but the bulk of it is tech. Now, the reason why it's that is because it didn't start this way. The 10 companies I had when I first started investing, it really was all over the place. And to be honest, when I first started my journey, I had over 50 to 70 different companies, and it was really hard. But when I started utilizing the 80-20 principle and I started seeing what was really performing, what was bringing home the bacon, what was doing most of the work, well, it turned out that a lot of it were my tech companies. And so I doubled down on that. I kept on investing more into that. And that doesn't mean that I'm all tech, but it does mean that right now they're pulling the most weight, so I'm giving them the most shine.
And to some extent here, someone might say, well, if you're kind of just doubling down on the winners here, are you chasing returns to some extent? What would you say?
I'd say that I'm proactively supporting what's already working. And so it's not necessarily that I'm chasing returns, even though you could say that there's an element of that. But what I'm really doing is I'm rewarding the companies that have been performing and outperforming the others.
Sure, that makes sense. Now, I also want to flex a little bit of my grade 10 math skills here, because to a keen-eyed viewer, you would notice that your tech exposure is 81%. And somebody might say, well, how do you get 81% with just 10 securities here? Can you explain how many stocks and securities that are actually in your portfolio today?
Yeah, absolutely. So I invest for different goals at different points in time. And I believe that you should have your own account, a retirement account separate from your job. I also believe you should think about your children, legacy, think about your parents. And so there are so many different accounts that I have for myself and our family. And now in any given account, it will have just about 10 companies that are really working for us. Each account has its own separate group of 10. And so for this account specifically and my portfolio, you'll see that of the 10 companies, 8 of them are tech. And you can have companies like Amazon, Nvidia, it really doesn't matter, but it's really tech strong. And in terms of the other ones, it might be energy or consumer discretionary. And a lot of it too could also be a fund. And so I get double exposure when I invest in my ETFs as well as my own individual stock investing. And I think that's also captured here.
Right. And then the other aspect of this that I thought was really interesting when we were talking off camera here is that you aren't always sticking precisely to 10 securities in your portfolio. Sometimes you have a little bit more, and then you kind of pare it back. Can you just kind of walk us through how you do that?
Absolutely. So when I think about the 10 companies, I think about who is going to be here for the longest amount of time. Now, that doesn't necessarily mean forever, because markets operate in cycles, and so do companies. And so I might have something where for the first 3 years it was doing great, but then I noticed that there's a downward trend and the company's not performing as well. I don't want to, at that point, open up a vacancy for another spot in my, special 10. I want to have runner-ups available. So I might, alongside the Big 10, I might invest a little bit in other companies just to see when one of the 10 companies aren't doing well, I can safely put in another company to go into that 10. Now, in terms of reinvesting, I typically only reinvest in those 10 companies. The other companies that I have in the portfolio, they're just a tester to see if they can perform and hit the metrics that I want for my portfolio.
Aha, okay, so little exploratory positions, if you will, that you then kind of pare back depending on the results, basically, is what I'm taking from that.
Absolutely.
Okay, awesome stuff. Well, Ange, listen, we appreciate that you giving us a peek inside your portfolio here, explaining the rationale. We got a lot more to get to, but before we continue, just a quick shout out to our viewers here. Follow TD Direct Investing on YouTube, Instagram, and Facebook, because you can get a sneak peek at all kinds of upcoming episodes that we have on our live shows and a ton of other content designed to help you build your investing knowledge. You can see the QR codes on screen there. Give them a scan, check out what we're all about here. All right, Ange, let's get back to the conversation here. We heard all about your rationale for the 10 security portfolio, 10 stock portfolio, if you want to put it that way. I want to hear about some of your tips for actually building one. And I think for a lot of beginners just getting invested into the market here, the obvious question is, how much money am I going to need to build something like this?
That's a great question. People ask me all the time, how much money do they need to actually start? And the reality is it's probably less than you think. You can buy one share at a time or even fractional shares if your platform offers them. You don't need thousands to begin. When I started investing, I simply had hundreds of dollars a month at most. And because I was able to purchase fractional shares, I could get just a little bit at a time. It's really about building that habit and seeing if this is something that can truly work for you.
Now, fractional shares, a fantastic feature that many brokerages offer, TD Direct Investing being one of them. Can you just explain for somebody who maybe not has heard the term fractional or partial shares, what that is and why it can be beneficial to an investor who maybe is working with a little bit of a budget?
Fractional or partial shares are really important to know, especially if you're working on a budget, simply because instead of purchasing the entire share or stock of a company, you can purchase a little slice of it. I love to think about it in terms of a cake. Instead of purchasing the whole cake, you can purchase a slice of cake and still enjoy the benefits of having the cake. And so an example would be if a share price is $500 and you get a partial share, you put in $50, you're still going to have 10% of that stock, and it's going to still grow the same exact way that the stock would have grown if you were to have a whole share.
Right, and the idea here is that you just get that compound interest effect going sooner. You're using every dollar that you have available to build your portfolio, and hey, who doesn't like that idea? So if you haven't used partial shares yet, check them out for sure. A great thing to consider here. Now, Ange, another thing I wanted to ask you about was, how do you decide which of the 10 stocks that you've bought in your portfolio that you're going to put more money towards? You talked about it a little bit, but I was hoping you could maybe flesh out your thought process there.
Absolutely. So I want to keep supporting the winners. And I love supporting the winners because as the price is going higher and higher, that means that the money that I put in the past is becoming more and more valuable. Now, a lot of times people would think, okay, if this is the case, what does it mean if I give to one company and not the other? How do I decide that? Doesn't it mean that I'm paying more? Technically, am I not paying more money for something if the price is getting higher and higher and I'm investing in that? And what I love to tell our students is that's okay. It's okay to buy something at an all-time high, because the all-time high today might very well be one of the lower points in the future, and you just never know. You don't want to time the market. And so when I think about how do I start investing, I will actually put money into almost every single one of the 10, as if I think about them as if they are my children. It's dinner time, they're all eating, and everybody gets a plate. And so I will divide whatever my budget is amongst all of them. And when I have a bonus or an influx of cash, then I'll give it to the star people. I'll give it to the kid who's been behaving the best, and they'll get a special reward of extra money.
Okay, I love the analogy there. I'm a new father myself here too, so that definitely rings true to me here, making sure everybody gets what they need here. One of the things I actually found really interesting too, that when I was researching for this episode, I found, to your point about investing at all-time highs when the stock is expensive, is that success tends to beget success at that point. Even if you invest on the all-time high days, like that chart that we showed there shows, it actually was slightly better doing that than investing on any other day, if you can believe it or not. Because again, the momentum continues up when there's a successful company and they're doing something right. They tend to continue to do things right. So yeah, not something to necessarily be afraid of, as you said here. Now, that's when you have figured out the stocks that you already hold, but how do you even get to that point? Like, there's hundreds upon hundreds of stocks and securities writ large out there. How do you get down to figuring out which deserve to be among the 10 in your portfolio? How are you getting that information and researching these things?
I decide who gets to be in my portfolio by doing a lot of research. When I first started investing 19 years ago, it would take me days and hours to figure out what could be a good investment. Is it going to perform or not perform? I'm happy to say that since creating the Happy Investor Method, that it now takes me about 30 minutes to decide if a stock is for me or not. And so my skills have improved, and I'm so happy to share a bit of that with you all. And so one of the things that you want to think about is you want to think, how does this company make money? If you can't explain it, then don't buy it. But this doesn't mean that you shouldn't go ahead and do your research. A simple internet search of how does this company make money will give you so much value and answers, and you might even be surprised. So that's something you really want to be mindful of. You also want to look at their financial statements to look at a track record. I love going through investor presentations to learn more about their industry and what they see the potential is in their growth. I always love to look into the corporate social responsibility, the CSR reports, to see what they're doing to give back to community and to really improve the lives of others while they're out, making a ton of money. And what I also love to do is I love to figure out exactly what is the story of this company. Now, I don't want you to get into a really big rabbit hole, because it could. Like I said, it used to take me hours. So I don't want you to get into analysis paralysis. What you really need to do is maybe set a timer or give yourself a specific amount of points that you want to get answers to, and then decide to make a decision.
Yeah, certainly it's very easy to get caught in the internet rabbit holes that you can fall down regardless of what the topic is, but certainly when it comes to stock research, not something that you have to do all in one sitting too. I think people might get intimidated by that, right? Like, this is something you can do piecemeal over time.
Absolutely. I used to do it for days. I would have one stock a month. And then at one point, I started figuring out shortcuts. And then it became, okay, I'll focus on one stock a week. And then it became, okay, every, 2 or 3 stocks a week. And so definitely take your time with it. You want to get as much information as possible, and you don't want to get too you want to make sure that you don't get too emotionally invested. You want to make sure that you're looking at it as if you're just reading a paper and you're gathering facts. I don't want you to think too much about the emotions involved just yet. Just get the information you need to make the decision that's best for you.
So in keeping with a more stoic approach to research, let's call it here, what are some of those key criteria that you're looking for in the nitty gritty of all these information sources that you talked about there that suggests to you, hey, I could be onto something good here. This might be worth holding in my portfolio?
I love looking at revenue growth. Revenue growth is really important because I can't expect a company to make money for me if they don't know how to make money for themselves. And so you can't expect a company to make money for you if they're probably not that great at making it for themselves, at least in the long term. So revenue growth is huge. Earnings growth, management's track record. So I really want to see how good is this company and the leadership they have in place to handle the good times and the bad times. I want to make sure that it's aligned with the industry trends. Are they in front of their competitors? Are they lagging? Where are they going for the future that I personally think and that you think our world is going towards? We want to check out the return on invested capital, the return on equity. And I pretty much want to see, hey, when you have this money, what do you do with it? And once I figure all of those things out, plus a little bit more, then I feel pretty comfortable with moving forward.
Yeah, there's some little bit of like jargon terms in there when it comes to stock research. Don't be intimidated, folks. It doesn't take that much to wrap your head around it. But Ange, I thought you did a nice job of kind of summarizing like this is kind of what you're after when you're looking at some of these metrics here. One thing that I think a lot of folks, whether they're new to investing or not, consider is the opinions of others. A lot of folks, they'll hop onto YouTube or something like that, and they'll listen to like what are influencers saying? Influencers like yourself, even, right? How much do you consider the opinions of, it could be online personalities or some kind of money manager or somebody like that online that you see in media or on social media when you're sort of formulating your thesis, right? And deciding whether you want to invest in that stock or not?
I think it says something to be able to get someone's shortcuts. Before, we would have to go through so much research or maybe go to school and do a lot. And I love that in today's day and age, you can go to someone and find out what their experience is with investing, learn their shortcuts. This said, even though I'm an expert, like Ange Matthews, I'm an expert, I'm a speaker, I travel, I talk about this all the time, but you still have to figure out what your goals are for your investments and your money, because it might be different than the person that you're listening to. So the first thing is you want to understand that, hey, you have to take this information with a grain of salt, because what I tell my students is, hey, when you retire and you're off somewhere on an island, I'm not going to be there with you. It's just going to be you and those you love. And you're not going to be on my island either. So you want to make sure that the things that you're looking for are aligned with your goals. You want to make sure that if you're a long-term investor, you're getting insight from folks who want to hold their assets long-term. If you're a short-term investor, get insights from someone who's holding it short-term. To give you a bit of an example, I think it's important to learn from experts and others, but I also think it's important to do your own research, have your own goals, and go after your own dreams on your terms. And you'll only figure that out with practice.
Yeah, right. So it's you can't just take the easy shortcut. You want to, what's that analogy? You give somebody a fish they'll eat for the day. You teach them how to fish, they can feed themselves for years. Like that's really what we're after here, it sounds like. So appreciate your perspective on that. One last one for you, if I could here. What are some of the top tips that you have for investors to grow a portfolio and stay committed to it through really volatile and uncertain times like we're dealing with right now? A lot of folks, again, beginners or otherwise, are anxious about this stuff. Any tips for them?
Absolutely. Over my investing career, I've invested through a recession. I have invested through the pandemic and also this recent downturn. What I know to be true is that the success that I have in terms of my personal investments and my investments are probably about 20% more successful than the average person. And the reason why is because I love to buy stocks when they are on a discount. And when everyone is freaking out, what I love to do is I love to take a breath, because that initial fear is there, but I take a breath and I think, is this a really good buying opportunity? So I love to buy stocks when they're on discount, and I really enjoy this because there's an element of catch up. You know, the Ange that's here today is not the Ange from years ago. I didn't always have funds to invest. Sometimes life got away with me and I wasn't the most consistent. So I'm always looking for opportunities to catch up, to buy companies at prices that are much lower than what I've paid for them in the past. And I know these are solid companies. They'll probably come back up, and it probably has nothing to do with the outside factors that are making them down. So I do think that over time, that's really what's going to help you as we experience the tops and the bottoms of the market. Just really go in with the perspective of, I'm looking to purchase perhaps at a discount. I'm looking to catch up on time.
Yeah, one of my favorite charts of all time is one that it shows the performance of the S&P 500 over the last 100 odd years, and punctuated throughout it are all the terrible things that have happened all along the way here, and yet somehow we continue to march higher. The market does here. So it kind of helps you give a little bit of perspective here. When in doubt, zoom out is one of the favorite phrases that I've heard there. Ange, really appreciate you sharing your perspective on building a small but mighty 10 stock portfolio here. We got a lot more to get to here, but one of the things that you caught my interest with here was talking about the value of using partial shares to grow a portfolio a little bit faster here. So on that note, I want to bring in my colleague, Caitlin Cormier. She's going to show us how it's done on WebBroker. Caitlin, are you with us here?
Yes, I am. Hey, Rob.
Welcome to the show. Summer in full swing here. So for those tuning in here, if you want to get started with partial shares on WebBroker, how can you do it?
Yeah, partial shares, they're a great way to get invested, either with just like a piece of a stock or just to get every dollar invested. If you're looking to invest, $500, you want to get it all in there as opposed to leaving cash in your account. So let's look at how you can put those trades in on WebBroker. So I'm just going to pull up an order ticket here. So just click my buy sell button. I'm going to go ahead and start my order entry. Of course, we want to make sure we always have the right account. For today, I'll use a US side because I'm going to use a US stock to go through this process. So I go ahead and select whatever security it is I want to purchase. And what I'm looking for is this right here. So this little pie piece, if you can see where it says fractional and it looks like a circle with a little triangle out of it, that is what we're looking for in order to be able to place fractional share trades. There are some securities that don't allow it. So for example, and this is one that does not, you'll notice it has kind of an X through it or a line through it to show that it is not a fractional share eligible security. So just make sure that it shows that green, and that will let you know that you are able to do those fractional share orders. You can go ahead and do the dollar amount, or you can do the number of shares. So as you can see here, I have like 5.5 shares. If I were to choose a dollar amount instead, I could say, I have $500 and it'll tell me how many shares I can buy with $500. So that's kind of a quick overview of how you can enter those share orders on WebBroker.
Very cool. So, partial shares obviously being one tool that you can use there. Are there any other little ways that you could, in the order entry process, stretch your dollar a little bit further?
Yeah, absolutely. The other type of order that can help when you're kind of really trying to budget and make sure that you know how much you're going to be paying for security would be a limit order. So if we hop back in and look at limit orders, now one thing to keep in mind is that you're not able to do limit order and partial share orders together. So if we look at this same order ticket where we have this fractional, if I click limit, you'll notice that the fractional is now going to be crossed out, meaning I'd have to do full shares if I want to do a limit order. But what happens is if I look at this share and say, okay, it's currently trading for 224 approximately. Let's just say I only want to pay, let's just say 220 for this particular stock. If I want to pay something less than what it's trading for right now, I put in whatever the most I'm willing to pay for this stock is. It could also be something like, 224, or I could even put a higher price of 225 just to make sure that I'm not going to get, if the price kind of shoots up, that I'm not going to be paying way more. But I put in whatever the maximum I'm willing to pay. And then that way, regardless, I know exactly what the most I'm going to pay to get into this trade is. It's going to be my limit price multiplied by how many shares I'm purchasing. And that's the max I'm going to pay. So it really is a way to sort of confirm that you're not going to pay more than what you plan to for a share. Or if you want to kind of wait and see if you can get a lower price, you can choose, for example, either to leave it open for a day, or you can leave it open kind of for a longer period of time if you so choose. So yeah, there's a couple different ways that you can do that. So those are two different ways that can really help you sort of stick to a budget or get every dollar invested when it comes to trading with TD Direct Investing.
Awesome. Getting your money to work for you as hard as possible. I love it. Thank you so much for showing us the ropes there, Caitlin. That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. Okay, Ange, we are going to open the floor and take questions from our viewers now. We got a flood of questions coming in here. Are you ready to hear what people want to know more about?
Let's do it.
All right. So let's take our first question here. This one is coming to us from Nozer. And Nozer wants to know, should we be investing in global or international equities or in Europe-focused ETFs, for instance? What do you think as tariffs are rattling the market here? And any thoughts on the type of diversification that people might want to consider?
I think we live in a global market. And so to an extent, you'll still have exposure regardless. I invest in the entire global market. If I'm going to do that, I will do a fund that reflects the total market index fund, which captures assets from around the world, securities from around the world. I do think that as we become more and more into the system of tariffs and how we play together as neighbors and family from around the world, I think it's okay to have a bit of nationalism and invest in your own market. But I also think it's really great to diversify and invest in the whole thing. It's not necessarily that you're investing in one country or another. I think a lot of times what people fail to realize is we're actually investing in the concept of investing. And once you start investing, that's what we're buying into here. It's not necessarily one country or the other.
Right. So if you're going to diversify. Right? Don't just be too narrow thinking about it. Okay, wonderful. Appreciate that perspective. Delicia has a question for us. I hope I'm saying that right. How often do you review the performance of those 10 shares? Good question.
So I review it monthly, and I do a very intense deep dive quarterly, meaning seasonally. And the reason why I do this is because I'm a longer term investor, meaning that I plan on holding these companies for anywhere from 6 months to forever and passing them on to my children. I don't want to freak out about the day-to-day activities of my companies. If I were to always be glued to my phone looking at the company's performance, I might miss the bigger picture here, which is over a period of time, is the company making money? And so I typically check in about a month. I do have a notification set up just in case there's something crazy. I like to think about it in terms of a fire alarm or just in case, something happens. I do have alerts set up with price points and percentages to let me know if I do need to go in within that month and it's not the time yet.
Right, so striking a balance between, not obsessing over your portfolio, checking it all the time, which I know some people are often tempted to do, and also, still keeping a close eye on it regularly here. Okay, that's awesome to know. Zand has a question for us, and Zand wants to know, my daughter is 20 and has set up a brokerage account with $2,000 in it already. Way to go, Zand. What would you advise she buy with that money right now? Now, of course, we can't give explicit financial advice on this show here, but in general strokes, what do you think for somebody starting out? They're a young investor. They've got a little bit of money to play with. Do you think there's any sort of guiding principles for them, Ange?
Well, I love, in the Happy Investor Method, we are values aligned. And I think that the younger generations do have so many principles and values. And so I would love for her to look into actually purchasing things that make her her. And what does it look like to own shares in the company that she might actually work for? What does it own to own shares in devices that she uses? Things that are really important to her. I think that's a really great age where you have a little bit more time to catch up just in case you might make a little bit of a mistake. She has time on her side. And then, of course, I don't think there's anything wrong with doing a fund that can just generally capture the performance of the market. So a total market fund, maybe investing in an index. She's at this really beautiful age where she gets to build a relationship with her money as she makes it. And I think that's probably the most important thing for her to do right now, is just to start small and start learning her investment style.
Yeah, and it goes back to what you were saying too. You want to be really invested in investing, right? And that's kind of the most important foundational step at that level that somebody could really pursue before we even get into what are the specific things you invest. A lot of time to make up the difference, right? Retirement or whatever you're saving for is a long ways away. Yes. Trevor has a question for us. Trevor wants to know, what's the highest percentage of your portfolio that you've put into a single stock? Really good question, Trevor. Ange, what do you have to say?
I love this question, and I can actually pull it up because I take screenshots of my portfolio. And so I try to do, say, over the last 5 years, the highest one that I've had is about 239% in one single stock. Of course, I have had companies for longer than that, about 15, 19 years, and the highest I've seen was about 856%. And so it can get really high up there for the individual companies, especially if you can hold them for, 2, 3, 4, 5 years and let that compounding take hold.
Okay, so you're talking about like the returns that you've gotten off of a single stock?
Yes.
Okay,
I'm
I
not
think
sure
I could have misinterpreted, but I think what Trevor was after was like, how much would you let one position in your portfolio take up out of the whole? Like, would you let one stock be like 60% of your portfolio, or do you try to keep it more contained than that?
Got it. I try to contain it more. Now, of course, sometimes we have companies that do stock splits. And so it might have started where a company was a tenth of the portfolio, and then it would do a stock split and it would grow ridiculously big. And then it would all of a sudden become 15 or 20% of the portfolio. So I really try to have a bit more of a balance at any given point. I can't have one company really be the make or break of my portfolio. That's really dangerous. And so I wouldn't do more than, say, 25%. And that's still pretty high for one company.
Right. And that kind of speaks to, again, the diversification that you were talking about earlier, that you think you can strike it with 10 or so securities. But again, it comes down to not letting one get way out of hand here as far as like the share of the portfolio. So good perspective on that one here. You were talking about, too, the returns that you got off of some stocks. Really impressive returns, so well done. Let's fire up the next question here. What do we have on screen here? Serge has a question for us, quoting the great investor Warren Buffett. Warren Buffett said you only need to get 2 or 3 good stocks a decade. So isn't 10 too many? So here we got the other part of the conversation, I guess, which is to Warren Buffett's point here. He likes a really concentrated portfolio. So why do you think that you'd want to go as high as 10? Why not go lower than that? 2, 3, 5, something like that?
The reason why I think and I believe you wouldn't want to go with just 2, 3, or even 5 companies in your portfolio is it's going to take time to figure out who those companies are. So I want you to think about a football team or a basketball team. When you're thinking about who the MVP is, when it's the beginning of the season and everyone's trying out and they just got onto the team, you might have a hunch who the MVP could be. However, you might not truly know who the most valuable player or the most valuable company or stock is going to be. And so when I think about 10, that helps me to understand who could potentially rise to the top. There's enough space there because I do believe that it might be with the 80-20 principle. 2 out of the 10 might be the ones to blow it out the water, but we don't necessarily know who those 2 are going to be just yet, which is why I love having at least 10 so that we can give time and see who that is.
Okay, yeah, that's a great explanation. Serge has another one for us here. So, Serge, you get a 2-for-1 special here. What about AI tech bubble risks, similar to the .com crash and the internet bubble that we saw in the early 2000s? Is that something that you're worried about as someone who's really heavily invested in tech, Ange?
It's something that I have considerations to, but it's also rapidly growing. And so I don't want to be on the sidelines where that growth is happening and potentially miss out on that actual returns of that. What I do is I protect myself by putting up my alerts. And so I love alerts. And in the event something should slowly go down, I am alerted to it so that I can make a logical decision if I want to sell that or not sell that. The other thing is, because I'm so heavily invested in tech, I don't just go straight for the AI. I invest in things that make this possible. So that could be energy companies. That could be manufacturing companies of pipe and hardware, because they actually have data centers that they have to build and create. So I invest in things that are directly a part of tech and potentially AI, and also things that are just feeding into the system that would also feed into other systems. Like I mentioned, hardware and materials and steel, all of those things are the same elements that could ideally be used for building a hospital or a school. And so the company has diversification in its revenue, and I'm okay with that. It's not just tech.
So it's not quite as simple as just all tech stocks are the same. There's a whole aspect to any industry, really, and you're looking to get a piece of different parts of it. Really thoughtful stuff here, Ange. Ankita has a question for us, and Ankita wants to know, how often do you invest? Is it whenever you have the money? Is it on a regular schedule, like every 2 weeks or something like that? And how do you allocate that money across the portfolio each time? And we talked a little bit about that aspect of things, but give us your thoughts.
Frequency of investing. Initially, when I started, I only did it when I thought I had a lot of money. Now, as we know, human nature, oftentimes that thought doesn't happen very often, where you think, wow, I have a ton of money. And so with that thought, I didn't invest as frequently as I probably should have, looking back at it. What I've come to realize is that over time, consistency is key. So I do love setting investing as a habit, whether that's every 2 weeks, every week, or every month, but you want to have a consistent habit. Let's say if you invest every single month, well, that's 12 times a year that you're investing. Over 3 years, you've invested 36 times. That's huge versus thinking, well, when I get a huge amount of money, I'm going to invest. How many times a year does that happen? So at the basic, I do a frequency amount of investing. Then when I have, say, a really good year, our business is highly profitable, or one of our investments, we cash out and we have a really nice surplus, or there's a great tax year, whatever that looks like. What I'll do is I'll take a percentage of that. I'll say, hey, this was really amazing. I'm going to take about 30% of this money that I didn't even really anticipate being here. I'll take about 30% of that money and I'm going to invest it into Ange's future. I'm going to invest it so that one day future Ange is going to say, like, wow, where did this money come from? And it's going to be because I took a portion of something really amazing and I stretched it out over time.
What you're talking about there is what's often called pay yourself first, right? Always having a little bit of money coming towards investing, because if you wait till the end of the month or whatever it may be to invest the money that you have left over, chances are you ain't gonna have any money left over, right? You spent it all. You wanted to put it somewhere else. So great idea there, Ange, and one that can be really powerful, especially over long periods of time. Rowan has a question for us. Let's check out what Rowan wants to know. He says, do you like to buy dividend-paying stocks? What do you think, Ange?
I do. I have dividend-paying stocks, and I love that every month there is the potential to get returns, or quarterly, however often the dividend payment is. Right now, I love activating the DRIP, which is the dividend reinvestment plan. And what I do is when the company gives me dividends, maybe right now it might honestly cover the cost of dinner, and it's not going to make or break the quality of my life. So I say, go ahead and just buy more stock, and I will save the dividends later. So my goal with the dividend strategy is to get as many shares as possible, so that one day when old Ange is sitting, on her couch and she checks her phone, I get a dividend payment that could potentially cover the mortgage or do something beautiful with. So I do have dividends, but at the same time, it is not a huge amount within my portfolio. It is a limited amount, because what I've realized is that oftentimes growth companies don't pay as much dividends because they're focused on reinvesting the money and the profits on getting the company to grow. And so sometimes we have to make a bit of a decision to decide, do we want the dividends more than we want the growth? And you can have both, but you just want to have a real choice in that and think about that.
Fascinating perspective, Ange. Really appreciate you giving your take on dividends and all those fantastic questions that we had coming in here. That's unfortunately all the time we have for our Q&A, though, but really appreciate you playing along and giving us a sense of this 10-stock portfolio. Really fascinating stuff, and hopefully it gets people motivated to start if they were a little bit hesitant to, thinking it takes too much effort. It doesn't have to, as you explained to us. Thanks so much for joining us. Thanks for taking the time.
Thank you so much.
And by the way, good luck at FinCon. For those who don't know, Ange is going to be a keynote speaker at the FinCon conference coming up in a couple weeks here. No pressure, Ange. I know you're going to knock it out of the park, but have a great time in Portland, Oregon.
Yep, and I'm excited for the Happy Investor Method to really blow it out the park and to show what's possible. So thank you for your wishes. Hope to see you there.
Awesome. Yeah, we'll be watching for sure. And for those in our audience, thanks so much for tuning in as always. Make sure you check out next week's episode as well. We've got tariffs rattling the market here and some investors rethinking their exposure to the US. Well, we're going to explore a way to diversify into international companies in Canadian dollars that you might not know about. So make sure you tune in for that. That's all the time we have for this episode, though. From everyone at Inside Investing, thanks so much for watching, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.